Hey everyone, me Kevin here with updates on 5 stocks that you should either buy, sell, or just own and hold. Let's go ahead and start with Lemonade. Then we'll hit Shift Technologies, jump into NEO and XPENG, we'll give updates on these, and then we'll make a note about Nikola and, well, buying short positions, or buying puts, or potentially just shorting the stock, and talk about what the heck is going on over there. But right now, let's start with Lemonade. Right after I mentioned that you should get 4 free stocks with Webull. Deposit $100, get 4 free stocks worth at least $21 and worth all the way up to $1,600. So it's a guaranteed minimum 21% rate of return while the promotion is going on. And of course, get life insurance in as little as 5 minutes. Which, speaking of life insurance, Lemonade will be selling life insurance at some point in the future. So that'll be interesting to see when that product gets added. But for right now, you could use the other life insurance company link down below. Lemonade, the insurance company, shot up 20.23% today and another 1.43% in after hours. This is a company that I have over $210,000 invested in, and this 20%, well, it makes for a nice day. But what caused this run up? Why all of a sudden would Lemonade go up 20%? We've been buying this thing since it was under $60. Bought it at $59, at $55, bought it a lot at $48 and $49. I've been talking about this stock for probably 4 months on this channel now. I've been mentioning it in stimulus videos. I've been throwing it in the course almost every single day. I mention, oh, Lemonade, it's under our target. Buy some more, buy some more. Every day in our live streams, which obviously you can get if you're in any of the courses linked down below. But folks, Lemonade, why would it just move 20%? So what the heck happened? Well, here you go. At 1 p.m. Eastern time, Lemonade was trading for around $74.55, which was great because I've been recommending buying this company under 65, ideally under 60. That's been a good price target for me as an entry. Well, then all of a sudden it ran up within a matter of about 15 to 20 minutes, 20%. And that made us all kind of scratch our heads. What the heck is happening? Well, we found out exactly what's happening. Lemonade was pitched by the Motley Fool's stock advisor. And what I figured we could do, because I've got their subscription, I figured I'd go through and do a quick little peek and see what they say about it and where we can add some commentary. But then I want to give you a warning on Lemonade. So they mentioned that Lemonade has this proprietary technology. Basically, Lemonade is an insurance company that tries to use algorithms to quote you for insurance and also to deal with your claims. The cool thing with this is they will actually try to use all of these thousands of signals they can collect on you to, like, the micro point of you literally opening up the terms of service or not. Like, that is somehow related to a signal as to your likelihood of putting in an insurance claim. And they say that collecting hundreds, maybe even thousands of signals like this lets them price insurance more competitively and lets them assess risk more competitively. Who knows? Because they use something called reinsurance, where they basically take a portion of their portfolio and reinsure it by getting insurance on their insurance, basically. It wouldn't surprise me if Lemonade kind of just gives what they deem to be the riskier part of the pool to the reinsurance company, although I don't know if it could work that way. Either way, they do use algorithmic technology like crazy to not only make the sign-up process really easy. In fact, if you've never done it before, go to lemonade.com, try to sign up for insurance, chat with the bot, and you'll see how easy it is. They only operate in about 21 states, though, so you don't have access everywhere. Might be a little bit more by now. But anyway, Lemonade is really that millennial buy. That millennial generation is eating up Lemonade. And so Motley Fool says, hey, look, they've got a fresh approach to a stale industry. This is true. They call them a mid-cap. 4 billion valuation. Honestly, nowadays it's pretty small. It feels like small cap to me. But fine, old school technical, fine. But, they say, look, old school days, it took forever to fill out an insurance application. Then big insurance companies are like, hey, we can get you a better quote in 15 minutes. But Motley Fool says, hey, no worries. Now you only need 2 minutes to get an insurance quote. And that's really exciting to millennials who don't want to get on the phone and don't want to waste their time. Quite frankly, I resonate with this. Like, this appeals to me. I like this. And this is why I like Lemonade. Honestly, I can't wait until they get into rental property insurance, which they don't do right now, which is really annoying, because I would gladly swipe up to have an insurance policy, basically. It would be great for all my rentals. It's just a hassle. Emailing, age of this, blah, 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 blah. It is a hassle, so I agree with him on that. The Motley Fool accurately mentions here that the company keeps 25% of the premiums they get, and then they use reinsurance for the other 75%. Now, they actually end up calling this a risk. I've seen other companies like ARK Invest calls relying on reinsurance a risk factor as well. I don't personally see that as a big risk factor for Lemonade, mostly because the reinsurance market is pretty competitive. You're pretty capable of getting insurance on insurance, so to speak. And then anything beyond 25% in profits that Lemonade gets, they actually say they're going to donate that. So that way in low years, they're not donating, they're keeping more of their revenue, balancing that out with high years where they've got more revenue and donating the extra. So really what they're trying to do is say, we just want to be consistently profitable every single year based on the amount of users we have. And all we care about is growing our user base. We just want more people in the funnel. That's all they care about. And then that way they can try to predict, okay, cool. Well, if we're a little short this year, we'll donate less next year or whatever, but we'll always have the same profitability per customer. That means we can spend X dollars on advertising. And hey, if we spend $1 and get $2 back, let's just keep doing that. It's a little system they've got. Honestly, I think Lemonade's a great company. I mean, obviously, I think that if I got 200 grand in, I think it's like 210K. I always like to be transparent with you, and I'm going to tell you whether I'm going to keep buying or sell or what I'm going to do. Some of you can probably already predict what I'm going to say in terms of when I suggest selling. But anyway, okay, good, blah, blah, blah. Something that Motley Fool didn't talk about is, to me, Lemonade, while it's a great company, I worry it's going to be slow. And I mean that. Like, Lemonade relies on your typical millennial coming in, getting, renter's insurance. They even added pet health insurance recently, and then relies on that customer being so infatuated with the company that in the future, they'll go to the other verticals. They'll get the life insurance. They'll get the rental property insurance in the future. In the future, maybe they'll even go into car insurance, and they'll just get everything through Lemonade. Lemonade's like the new Geico, which Geico was a big bet for Warren Buffett and paid off really well for Warren Buffett. So that's Lemonade's strategy. The issue with that is it takes time for millennials to actually grow their assets to have more properties and products or whatever that they want to insure. Sure, you could start with renters and pets, but you're dealing with an audience that doesn't have as many assets to insure, right? That's the big thing. You don't have as many cars, you don't have as many properties. And they don't even do rental property at the moment. So you can see there are huge growth potentials for Lemonade. But obviously they've got to grow into that. And I write that this is kind of a slow process, but it's good because once the market realizes the potential of Lemonade, having all of this revenue build up small now and then it'll be explosive in like 10 years, that to me is why this is a buy. See, I kind of think of Lemonade like, imagine you're lighting a fire at a campfire or something like that, and you're going to light the fire, and everybody else is like walking around looking at your fire, and you've got your fire kindled, like your fire's starting to grow, it's brewing, and you're slowly adding to it, and you're blowing into the fire a little bit more, and everybody else is like, man, Kevin doesn't know how to light a fire, he got nothing, man. The fire is Lemonade, in my opinion. And then, everybody's kind of off doing their own thing, chasing, the nano dimensions and the Neos, which we'll talk about that in a moment. Not saying that's bad, okay? I like these companies. But they're distracted by, the things that are hot to talk about right now. And, before you know it, 5 years go by and it's like, I got this raging fire and people are like, dang, where did that come from? That's my POV with Lemonade, is one day the market will realize, oh my gosh, they got X% of all millennials having insurance with them. Geico and Mercury and all these other insurance companies can't even compete anymore because people don't want to leave Lemonade. That I think is where Lemonade's going. That's the long run growth potential for Lemonade. So to me, I bought this stock on IPO day, and I rarely buy stocks on IPO day. I bought it for like $54 on IPO day, and then I bought more as it fluctuated between 49 and I think the highest I bought it for was like 71. I threw in an order on M1 Finance for like $71 or something like that. That was high. But most of my cost basis is right around $58 for this stock, $55 to $58. So really love this stock. Great, great company. And I'm not going to go through all of the Fool article here, although, I mean, that was honestly kind of the end of it anyway. They didn't go super in-depth on Lemonade here. That's all right. They kind of just said, buy Lemonade and put a nice story on it. But so when the question comes up, why is Lemonade up 20% today? It's because of this article. Basically, they got a huge shout out. They're kind of a small company, and that buying volume led to the prices going up. I thought it was also interesting that I got the email at 10:38 a.m. Pacific time, and they, somebody started buying 30 minutes before that. But I guess you can't blame them for that. Anywho, that's what happened at Lemonade today. Now, what's my warning for this? I would not be surprised if you get a lot of traders that sign up for these stock alerts. They buy in to ride the momentum, and then they're going to start selling. And that's not to say there's anything wrong with traders. There are a lot of people who are in my course that purposefully try to trade off some of the things that I'm doing, which is fine. Like, hey, look, if you can make money off it, all for it, do it. My POV and my warning for Lemonade is if you're in Lemonade right now, know that there's a possibility we're going to go back into the low 70s, maybe even high 60s. I think this Motley Fool move will wear off. We've got some shareholder dilution coming up in January. It's quite possible the stock could run. And when it runs for real and we actually get hedge funds involved, I wouldn't be surprised if this stock ends up, 2 to 3xing over the longer term, the next 5 years. I think 5-year goal wouldn't shock me at all to see this 2 to honestly even 4x, because they're going to get that market share and all of a sudden the market's going to go, oh my gosh, they got all the millennials and now they're in 50 states and look at all the products they have. Once they open up the door to rental property investors too, like millennial investors, I think they got a lot of upside. I really like Lemonade. I'm looking into another one too called Root, but I don't have anything for us on that one yet. I'll be doing some research on that one this weekend. Okay, so next up, I want to just make a note about Shift. So Shift is the used car company, which sounds like not great because it's like, oh, used cars. Who wants used cars? The Shift is revolutionary. Their customer service experience is great. They are going to compete with Carvana. They are going to eat market share in every market that Carvana works in. These companies, Carvana and Shift, are going to take much, much more market share away from traditional dealers and CarMax and the companies that aren't really selling online. I mean, just the fact that you can sign up to buy a used car and somebody will drive the car to your house and you could test drive it from your house and buy it from there. It's incredible how streamlined and simple they make the process now. Carvana has blown up. I mean, they sell for like 4.5 times their future revenue in 2021. Shift, on the other hand, only sells for like 1.25 to 1.3 times their future revenue. So Shift has, in my opinion, this incredible potential to, over time, give it a few years. This is not tomorrow, but it has this incredible potential of really 5xing soon. Like once they prove themselves for a few quarters and we actually see that consistent growth, I think Shift has some really good potential. Shift, I've got about 125K in, not as much as Lemonade because I really just started buying Shift. So if I see some more weakness and I can keep getting Shift in like that $8 range, especially if I go sub $8, I'm just gonna keep buying Shift. Small company though, very small, so you're definitely subject to a lot of volatility over at Shift. But take a look at this. Okay, so this is the Carvana CEO. He's gonna talk to us a little bit about profit per car and what has happened by selling cars online, what kind of transition we've seen, and what we're expecting going forward. Just listen to him talk for a moment, and then we'll add commentary.
Sure. Well, I mean, we went public in 2017. In 2016, we made about $1,000 in gross profit per unit per car. And then, as you said in the intro, in the third quarter, we made about $4,000 in gross profit per car. So we've moved that up very quickly over the last several years. We've done that by vertically integrating, by making our customers' experiences more simple, by buying more cars from customers so we can cut out costs out of the equation that way, by giving customers a great financing experience. So we've really kind of built out in many different ways to continue to deliver that great experience for our customers while improving our monetization as well.
Huge. I mean, that's huge. They 4x'd their profit per used car. Folks, this is the future of buying used cars. And quite frankly, if we're going to go into what I think is potentially a frugal decade, people should be buying used cars. Unless, of course, they're spending money on Teslas, which is fine too, because we own Tesla. I don't recommend buying Teslas. I have Tesla. 2 Teslas. But it's a waste of money. You're better off putting the money into Tesla stock. In the meantime, buy a used car off Shift. I really like this. When I heard this, it reiterated my belief about Shift, that they are in an industry that is primed for disruption. I like that. I'm not going to go huge with my portfolio on Shift, but they're definitely going to be somewhere around 3 to 4% of my overall portfolio. Who knows? We'll see if as everything else kind of gets more expensive, like especially if Lemonade stays around these prices, I might lower my exposure to Lemonade and increase my exposure to Shift. So for me, Shift, the warning on Shift is expect a lot of volatility. It's a tiny freaking stock. One dude dumping shares, like somebody making YouTube videos just going, that's it, I'm out. It could make a difference, okay? Not me. I'm not talking about me either. No, I will not sell this stock. I'm holding this stock. And you all know I do as I say. Okay, next. Let's talk about NIO and XPEV. So, NIO and XPEV are a little funny. I really like these companies. I think they're great companies. Obviously, we've had a lot of concern with the House bill that was passed. It's passed by the Senate. We're expecting President Trump to sign it. I'm not going to go into that again. But basically, that there's that fear that, oh my gosh, could these companies be delisted? I made a video on this yesterday. If you want to know more about it, watch that video on NIO and XPEV yesterday and maybe Chinese delisting. But more importantly, what I think is really kind of funny to look at, and then I want to talk to you about my strategy and warning here, is take a look at this. This is a video that I posted on November 23rd. And I talked about the EV stock bubble, big crash or big opportunity, basically what's coming, right? And I talked in this video about how I think that prices going up at NIO and XPEV is unsustainable and they will correct. When they correct, I'm going to start buying into them as they fall. And once they get to my threshold as to where I think they're like a great deal, I'm going to buy them more heavily. Okay, well, that was posted on November 23rd. Take a look at NIO stock. November 23rd, NIO stock hits peak. Ever since then, it's been down. Okay, maybe I got lucky on that one, but let's just say the warning signs were all over the place that was going to happen. So what does that mean? Does this mean that NIO is a bad company and XPEV? I'm going to lump these together, okay? Are these bad companies? No. But they are expensive. When NIO and XPEV were selling for $20 to $30 in that range, both of them were about 5 to 6 times as expensive as Tesla. That's a lot. That means for every dollar of earning, you're paying substantially more to get into NIO and XPEV. To me, that's sometimes okay, especially when you're starting with a really, really small company. But my recommendation right now is if we keep getting these negative 5% days, feel comfortable nibbling in a little bit. But don't go heavy on these companies yet. Instead, my POV is I want to make sure I'm picking these up when they're below my heavy buy targets. I'm going to pull up my heavy buy targets here, which I post these as alerts for my money and psychology of money course members. And so my alerts and my buy targets for NIO and XPEV is I want to buy NIO more heavily, under 40, ideally under 35. So I'm going to be a little hesitant in that range, but under those price targets, I'm okay adding to it. It's still more expensive than Tesla though. So honestly, if I'm putting $1,000 into NIO, I probably would want to set aside $4,000 for Tesla and throw that money into Tesla, but not yet on Tesla. I'm probably going to wait until after the S&P inclusion like sell-off that I expect is coming with all these traders who just jumped in on the Tesla inclusion bandwagon, which not trying to be offensive to traders here, like there's money to be made there as well, okay? But I think there's going to be a lot of selling pressure. We'll see. But I think we might be a little overbought, and then when the index funds start buying and the traders start selling to the index fund, it wouldn't surprise me if there were more traders than the index funds really needed. For XPEV, I really want to see them under 35. If I could get them under 30, much more juicy. These stocks are small. There's going to be volatility with these guys as well. But, keep this in mind. I mean, they're much larger than like Lemonade. Remember, Lemonade has a market cap of around $4 billion. $4 billion. You've got Shift Technologies has a market cap of like $400 million. NIO has a market cap of $61 billion right now. It's pricey. But it's also, you know, I mean, selling vehicles. You've got a lot of proprietary technology here. You've got great brand recognition. You got high profit vehicles too, which is good. And not saying that the company right now is making a lot of profit, but when they get to scale, you know, they're at that low profitability phase. But when they get to scale, there's gonna be a lot more profit per vehicle. Which will also help them with price competitiveness in the price war against China. I'm sorry, against Tesla in China. So a NIO and XPENG, what's the strategy? Well, in my opinion, you see a 5 to 7% decline, buy a little bit. You want to buy a little bit so that you don't panic and sell. Because when you buy, you don't sell. It could be $500. It could be $100. Just buy a little bit. So that way you feel like, oh sweet, I keep getting it cheaper. Just don't blow everything. Because when these things hit my price targets, no guarantees they will, but if NIO gets under $35 again, you want to be the guy that's able to go in there on a minus 10% day and go, I'm shopping, baby. I'm going in like it's Black Friday. We got Black Friday sale. That's my POV with NIO and XPENG. So if you bought and you're down on NIO or XPENG, don't panic. Hold these things. It's like, obviously no guarantees. I'm just some dude on YouTube, but I have no qualms about these right now for the long haul, and I will nibble into them on these red falls, and I will add more to them if they fall under my price targets. Okay, so that's now we've talked about Lemonade, Shift, NIO, and XPENG. Let's quickly talk about Nikola. So on Nikola, I want to note that 40% of the shares at Nikola are short. The market likes shorting Nikola, okay? So what this means is you have to be very careful if you're thinking, oh my gosh, Nikola's definitely going to go down. I'm going to short it. Nah, you got to be careful about that. Because if everybody thinks it's going to go down, well, then the profit is already priced in, and then it doesn't fall as much, and then people are like, it's not falling as much, and then they sell out, and the stock actually goes up. It's just the market. It's like playing, you know, chess. It's crazy. It's trying to always think 3 steps ahead of you. So keep that in mind when you're doing these trades. It's fine if you want to trade, but my opinion is the reward on shorting something like Nikola, low, unless they go BK. You know, that's I think when you're going to get your payoff. But I think they're gonna, you know, they've got enough investors in there to where they're in that hydrogen space, which not a lot of competition. They'll stick around and they'll keep limping around while everybody blows by them. And who knows, maybe one day they'll be something. But folks, keep this in mind. The reason people made big money shorting at the beginning of the pandemic is because very few people thought the market would actually crash substantially. It was every single day you had people like Larry Kudlow and hedge fund managers on CNBC going, this is nothing, don't worry, we're going to control this, we only have 1 case, oh, don't worry, we only have 10 cases, oh, we have a very resilient economy, everything's fine, until it wasn't. That's how people made a lot of money shorting, because there were so few other people shorting, you know, buying puts or whatever. So when everyone hates a stock like Nikola, gotta be careful. Don't short it. This is why I didn't say to short it in the last video I made on Nikola. I explained what's going on. I explained this big lockup coming up. But the market can sometimes do the opposite of what you're expecting because these things get priced in. So those are just things to keep in mind. When you get a lot of this selling pressure, a lot of the profit gets squeezed out by expectations. This is why you have companies like Hindenburg, a short seller, who basically will take a company nobody's paying attention to and do a hit piece on them. And all of a sudden, out of nowhere, this hit piece comes out and everybody's like, oh my gosh, this company sucks, panic, sell. Meanwhile, Hindenburg's already shorted the company. They're like, thank you, there's, 30+%. They cash out and they move on to the next company to screw over. Which, in fairness, you need companies like this to hold other businesses accountable, right? Like what Hindenburg did for Nikola, honestly, probably did the world a favor. So you can't bag on the short sellers for doing their piece in the market. But for me, my warning is just stay away. You're swimming against the tide when you're shorting a company. So keep that in mind. You short a company, you are swimming against the tide. You are betting against Jay Powell. Jay Powell, the dude with the money printer, does not like being bet against. He can just type into his spreadsheet a few more zeros and keep printing for a very long time. All right, folks, so there's my update on Lemonade. Wait, I gotta tell you on Lemonade. Let me just make this very clear because I don't think I said this yet. With Lemonade, I'm not gonna add to Lemonade at this price. We're $80. No. Wait for this thing to settle down. Can it balloon up? Can a hedge fund come in tomorrow and blow this thing up? Yes. So if you're gonna FOMO, you could buy. I'm not going to. I will wait to add to Lemonade. I just bought Lemonade 2 days ago too. I bought some more Lemonade because it had sold off down to like $63 a share, and I'm like, oh well, here's a little bit of a dip. Let's buy some of that. So you know, lucky on that timing. But I will wait for this Motley Fool enthusiasm to wear off a little bit. And honestly, I think they could have gone a little bit more detailed into their analysis. You know, they kind of just said, here's a company that looks pretty good, and we're buying it. Wow. Powerful. Must be powerful or feel good to be a fool. No, I like them. I'm not trying to bag on them. It just is what it is. So, okay, so Lemonade. Wait to buy. Neo and Xpeng, buy them when they're 5% down with little nibbles until we get to those price targets. Then we've got Shift. They're just a buy. Honestly, under $15, Shift is a buy. I won't buy it if it's up like 10 or 20% in a day, but I will buy it if it's down like 4% like it was today or yesterday, I think it was, I bought some. Neo and Xpeng, we wait. Nikola, just stay away from that one. Okay, cool. There you have it. Thank you so much for watching, everybody. And folks, we will see you in the next video.